InFi, Episode 5.
Welcome to InFi, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Welcome, everyone, to another episode of InFi. On this particular episode, it's going to be me versus Dave Ramsey. So specifically, Ramsey recently on his show had Jim from Nashville call in, and Jim was a fan of whole life insurance policies and their use as cash management vehicles. He had bought a policy for his young son and was calling to quibble with Dave over some earlier statements Dave had made regarding what Dave thought was the silliness of using life insurance in this fashion. And as we'll see, Dave certainly thought he took Jim out to the woodshed. The people in the comments in the YouTube post, 99% of them thought Dave handily disposed of this gentleman, Jim. But as we'll see, I beg to differ. All right, so let me just say a caveat at the beginning. Obviously, with these things, there's a temptation to get real into street brawling, and everyone likes to see a fight and such. So I am going to try to be fair when I go through this. So we'll see early on in particular, I think Dave's points were correct. And I think I understand what the caller was trying to get at, but he was fumbling around a little bit. But then by the end of the call, I mean, Dave was just saying flat out false things. And so again, it's, that kind of thing. So I'll try to be fair and not just be dunking on Dave Ramsey, but say where I understand why he was so adamant early on in the call and thought the caller was nuts. And then also my other disclaimer that I always make when I'm talking to an audience about Dave Ramsey is, back when I was in Nashville, Dave Ramsey and I went to the same church. And I didn't realize that until at some point he was going to do his money makeover program for our congregation. And the pastor announced it one Sunday, like, this is coming up, folks, because Dave Ramsey's out there. And then I was driving out of church, and because as those of you who go know that we're very nice and Christian and pious, loving our neighbors while we're inside the church. But once you get in the parking lot, hey, we're in the world here. And so I was coming out, and I don't know who had the right of way, but it was the kind of thing where I slowed down because this car was coming. And the guy waved me on to let me go first. And I was like, oh, okay. And as I was driving by, I realized it's Dave Ramsey in that car. So I want to pull any punches that I do in this. Also, joking aside, I do think Dave Ramsey is performing a valuable service with trying to get American households to cut down on their frivolous spending, to take charge of their finances and such, that I certainly need more of that in my own life. And a lot of Americans have fallen into a trap, getting overwhelmed by credit cards and frivolous expenditures and such. And so I do think Dave is performing a valuable service in that respect. Having said all that, what he tells his listeners about whole life insurance is either extremely misleading or just flat out wrong. And he doesn't just say it with a tone of humility and hey, go find out more for yourself. No, he tells people with absolute conviction, and they're idiots if they disagree. And so we'll see that confidence on Dave's part is misplaced often. Okay, so with that preamble, let's go ahead and start playing our clips here.
Jim is with us in Nashville. Hey, Jim, welcome to the Ramsey Show. How can we help?
Hey, Dave. Glad to talk to you.
You too, man.
Enjoy your show.
Thank you.
All right. I am calling in response to a video I saw recently that you claimed infinite banking concept was a scam, and actually got quite pissed off about it. So I do not agree with that in certain points that you made in that video. Mm-hmm. And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Say that again?
I said, I'm sorry.
Yeah, so am I sometimes. No. So I set that policy up for him when he was 1 year old.
Mm-hmm.
It has a $500,000 face value.
Mm-hmm.
We pay $5,373 a year for 13 years,
Mm-hmm.
and it's paid up at that point.
Mm-hmm.
There's a few points that I wanted to discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you,
Mm-hmm.
and you only get the face value
Mm-hmm.
paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value. Dividend reinvestment is because you have a mutual company and the policyholders are the owners of the company. And so the profits from the company come to the policyholder and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
But it still works out to be having a cash value much greater than the $69,849 we put in.
Okay, so I played a little bit longer on the front end than you needed for that exact clip just to give the overall context to understand where this caller is coming from, right? So again, he obviously is a fan. He refers to it as infinite banking concepts, going back to a term that Nelson Nash coined in his Becoming Your Own Banker, which uses whole life policies to not only provide the death benefit coverage, but to allow for you to finance your expenditures, remove your reliance on outside bankers, and hence become your own banker. All right. So, and the caller bought a policy for his son. I guess he got it when the kid was a year old and then started putting in $5,000 and change a year. There was initial death benefit of $500,000, which is going to grow over time because since the guy is into infinite banking, he's surely structured the policy such that the payments he's making are not merely for the base premium, but also are buying paid up additions. And then on top of that, as he was suggesting, the dividends that the policy generates, he has presumably elected to use those to buy more paid up additional insurance. Okay, so one of the features of that means that even though the face death benefits started out at $500,000 on this policy, every year that death benefit's going to grow too. It's not just the cash surrender value that grows, but the death benefit's going to grow also. And because he keeps buying more paid up additional insurance. Okay, so that's the basic premise. And obviously now he thinks that was a good idea. That's why he did it. Dave constantly lectures his audience that such a thing is ludicrous and you've been scammed if you fell for it. And so that's what this call is going to be about. So now on this first point, when I just stopped it here after that first clip, let me weigh in and to show that I'm a fair guy. I'm tough, but I'm fair. Let me say unequivocally, Dave is right on that point. Okay, that if somebody wants to know, hey, I'm looking at one of these whole life insurance policy illustrations, right, where it shows year by year, it's got a bunch of numbers, there's all kinds of columns talking about all kinds of different things. If I'm new to this, I'm trying to just parse this. What does that mean? So why don't we go ahead and we'll flash an example of a policy. So what we did here at Infineo is I asked one of my colleagues who's in production, hey, can you come up with a child policy with a split between base and PUA, putting in $5,000 a year? I think the guy said for 13 years. I think that's what he said. We had to trail it off a little bit at the end because what I wanted was that the policy's it's not like officially paid up after 13 years. Technically, you still owe the premiums, but by I think it was year 15 or something. Well, actually, I don't need to sit here and be guessing. I can look the thing up because I have it ready for a later clip. Yeah, so for this particular policy, you know what? I think what happened is I misheard the caller, and the instructions I gave to our guy, I said, have it start when the kid's age 5. And so that's why these numbers look the way they do. But he's putting in $5,000 a year. And then when the kid turns 19, it drops to $2,000. And then 20, it's $363. And 21, it's $219 annual out-of-pocket payments. After that point forward, the dividends in the policy are enough to cover the $5,000 premium. That's what's going on with this policy. Okay, so we were trying to mimic what the caller was talking about. Again, the timing on the early part was a little bit off because I think I had originally misheard what the caller said about the kid's age. Okay, so that's what we're doing with this. And at any given time, the cash value, that is the cash surrender value. And what that means is if you turn the policy back in, you get this cash amount, right? So the cash surrender value, as the name suggests, is what you get paid upon surrender of the policy. In contrast, the death benefit is what you get if the insured dies. That's what the payment is at that point. Okay, so if somebody dies, or if the insured dies, the beneficiaries get the death benefit, period. They don't get the cash surrender value on top of that. I'm just stressing this because two things. So one is there's a possibility someone genuinely misunderstands and just thinks flat out, looking at these policy illustrations, oh, if I got to be a certain age and I died at that age, if the policy's on myself, then my heirs get not only the death benefit, but also what the built up cash value is at that point. So I just want to clarify, no, that's not what happens. Your heirs get the death benefit. The cash value is showing what if you're still alive and you want out and you surrender the policy, you get a smaller cash payment, like a spot payment to just walk away. So you don't owe any more premium payments, but then the carrier is no longer on the hook for when you do eventually die. They're not paying a death benefit to anybody, right? Because they've already paid you the cash surrender value when you chose to surrender. Okay, so there's two different things there. It's important to know. It's giving you the optionality. All right, so the death benefit, as it goes up in a policy that's been designed in this way, where more paid up insurance keeps getting purchased year after year, so the death benefit keeps rising, but the cash surrender value also marches up over time. And the cash surrender value actually grows faster because by construction, for policies issued in the United States, when you reach age 121, they complete or mature or endow, and you get in cash what the death benefit was, or at that time. Okay, so again, the way in Canada, it's 100 years is how they build these things. Okay, so obviously, since the death benefit started out above the cash value, if they're both growing, but the cash value ends up equaling the death benefit at the end, that means over the course of it, the cash value grew faster, right, to be able to catch it. Okay, so that's how these things work. So again, it's showing you the options you have. It's an either or. If you surrender the policy, you get the cash surrender value. If you die, your heirs get the death benefit. You don't get both of them. Now, having said that, that's not something nefarious, right? This isn't the greedy insurance company ripping you off and, you got to read the fine print, right? Again, the very terms say what happens, right? You get the cash surrender value when you surrender. You get the death benefit when somebody dies. That makes sense. A way I try to motivate this for people who haven't experienced it before is to say an analogy with real estate. So let's say you buy a house with a mortgage. You got a 30-year mortgage on it. And every month you make your mortgage payment. And periodically you check in with your accountant and you say, hey, how am I doing? I've been making these payments for a long time. What do I have to show for it? And they say, oh, well, it's not like you're renting an apartment. Here, you're building equity in the house with each one of those mortgage payments. And then the accountant periodically will tell you, at this point, with the combination of rising real estate prices in your area and the fact that you keep knocking down the principal on that mortgage with the bank, your equity is such and such. And then, a year later you check in and now the equity has risen to a higher number and so forth. And so then by the end of it, let's say, you make that last payment in year 30 of that mortgage, you knock it out completely, and your accountant tells you, like, once you make that last payment, you're going to, have full equity. How you're going to have $455,000 of equity in that place because that's what we think the current market value is. You say, great. So you go to the bank. They acknowledge you made, that your draft on your checking account hit and you made that last mortgage payment. They say, congratulations. And they give you the deed to the house. It's yours free and clear now. There's no lien against it. And you're waiting around and you say, just wondered, I got to talk to a manager or something to get my equity. And they said, what? He said, yeah, so I got the deed. I got that. And now I would like you to give me a check for $455,000 because my accountant told me that with every payment to you guys, I was building up equity in my house. And like if I sold my house halfway through paying off the mortgage, how much equity I could expect to walk away with. And so now that I've fully paid it off and I have title and ownership on all of the equity, you've given me the house, I got the deed, and now give me a check for $455,000, which is what my accountant told me my equity is now. And so you can imagine the bank teller would be somewhat flummoxed by that. What are you talking about? No. What your accountant meant was the value of the house minus what you still owe us. That was your equity. And now that you've paid off the mortgage and we've given you the deed free and clear with no lien against it, that's what you own. That's your $455,000 at current real estate prices. That's what your accountant's referring to, right? And so if you insisted, and then if that guy stormed out and told his friends, I can't believe, they gave me the deed, but the bank held on to my equity. Geez, I thought I was getting both. That would be just a colossal misunderstanding of what was going on the whole time. So likewise, in a whole life insurance policy, the reason the cash surrender value marches up over time is because it's based on that future looming death benefit. That's what's driving it in terms of like the underlying actuarial calculations. So the cash surrender value, sometimes I refer to it as it's like a shadow of that future death benefit. So the death benefit's bigger, but it's not going to happen until the future if the person's still alive. And so the present value of keeping that policy in force has to do with how big is the death benefit, of course, but how distant in the future is it? What's the health status of the person? How old is the person? Underlying assumed mortality rates and such, that's obviously a factor. The distance in the future has to do with the time value of money. What are the prevailing interest rates, or what were the assumed interest rates when the contract was issued? And what's the nature of the contractual responsibilities, like the premiums, right? If the client still is on the hook for making large premium payments going forward, well, then that reduces the current cash surrender value because the client has to kick in money in order to keep the policy alive to get that death benefit down the road. Okay, so the net value of keeping that policy right now is lower if there's intervening premium payment stuff, right? So it's a complicated thing, but the intuition is, again, with each premium payment you make, you're knocking out one of the necessary cash inputs to keep the policy alive, and that looming death benefit is now that much closer in time. We don't know when exactly it's going to happen, but with the passage of time, it keeps getting closer and closer. And so that's why the cash surrender value marches up over time until either the death occurs, in which case, boom, the full death benefit is realized, or the person in the US lives to be 121, or in Canada lives to be 100. Okay, so again, it's the cash surrender value is like a derivative concept or value based on that larger death benefit. Just like when your accountant's telling you how much equity you have in your house, he's first starting out with saying, what do I think the current market price of the house is? And then what's the current principal on the mortgage? And then you subtract the two. That's what he means when he says, here's the equity you have in there. Okay, so it would be totally misunderstanding it if you thought you got the house and the equity as a separate payment. Okay, so now I've gone through all that. Now, at first when I heard that caller, I thought what he was getting at when he was talking about using paid up additions, and that maybe had something to do with this question about whether you get just the death benefit or if you get something on top of that. And so at first I thought he was making a really subtle point, which I'll elaborate in a second. But then I'm not going to necessarily play it here in this episode for you folks, but if you independently go and provide the links, of course, here to this stuff. But if you go and listen to the full call, or at least the excerpt that they put on the show, you'll see at the end, I think the guy actually just meant to Dave that, the cash surrender value at any given point is higher than the amount that I put in out of pocket. And it seemed like that was the leg he was standing on to try to argue to Dave that it's not true that the insurance company keeps my cash surrender value. Okay, so I think I get where the guy was coming from. Like he thought maybe Dave was suggesting you don't even get your money back. And the guy was trying to say, no. I mean, after a certain period, the cash surrender value is higher than how much I put in. So of course I'm getting more than my money back. I'm getting more than my cash back. So I think that's what the guy was thinking. But when Dave is saying when you die, the insurance company just gives the death benefit, not the cash surrender value. He means, what I said a minute ago. Okay, so I think here they just were genuinely misunderstanding what the other person was trying to say. So given what I now think they were both trying to say, they were both right, but you can see how that played out on Dave's show. He's, I think not only is Darth Vader, but even the Emperor is more forgiving than Dave Ramsey when it comes to people arguing about whole life insurance. Okay, why don't we... Oh, actually, I had promised you. Let me say the subtlety, though, that one of the things going on here is, like I say, when you use the dividends, and also if you've structured it so that your premium payments technically are not just base, but also paid up additions, and you're buying more paid up insurance along the way, that, like I said, moves the death benefit up also. And so that does come into play if you're doing something like a head-to-head comparison where you've got one person putting a certain amount into a whole life policy that starts out at a given face death benefit, and then you've got like the person's identical twin doing the same out-of-pocket contributions, but with, let's say, a 20-year term life insurance policy with the same original death benefit, and then that's going to be a cheaper premium, and then whatever the difference is in terms of the out-of-pocket contributions, take the difference and go put it into a mutual fund or something. Okay, so that's a very typical thing that Dave Ramsey does all the time to try to show why he thinks you'd be a fool to buy permanent life insurance, because I can always outperform that by doing buy term and invest the difference is the slogan they use. Okay, so I'm not going to go through on this episode. We'll save that for future ones, perhaps. I'm not going to go through and debunk what I think is a lot of flaws with the typical demonstration that seeks to show that buy term and invest the difference is hands down better than buying a whole life policy. So that's not what I'm doing right now. I'm just bringing up the fact that in those typical head-to-head comparisons, what's relevant is that if you're using your dividends and maybe part of your premium to buy paid up insurance, then the death benefit on the whole life policy every year gets bigger and bigger. Whereas if you just locked in a regular term policy with the same death benefit in year one, that's going to stay constant throughout. So that effect partially cancels out the effect that Dave Ramsey's talking about, whereby if you happen to die, at least in the period when a term policy is in force, it does matter, right? Like, so it's an important thing to know if you're doing estate planning and whatever, just making your financial plans. Yeah, it's important to know that the whole life insurance policy only pays the death benefit, not a cash surrender value on top of that. Whereas your identical twin who's doing the same out-of-pocket cash flows into a term policy and a mutual fund or something, at the point of death, would get the death benefit from the term policy plus whatever the mutual fund is worth at that time. Okay, so that's an issue. You make sure you keep track of all that. But like I'm saying, that's counterbalanced by the fact that the death benefit you get from the whole life policy is going to be bigger the longer we go into this experiment of buy term and invest the difference and put that head-to-head against the whole life, because again, the whole life's death benefit keeps rising. Whereas the term, if you just lock in a regular fixed 20 or whatever, 30-year term policy, the death benefit is constant throughout. Okay, so that's what I thought originally the caller was getting at, but then upon listening more, I don't think he was making that subtle of a point. Okay, let's now go ahead and play some more from the call.
Say he only lives to be 80, okay?
All right.
The cash value will be worth about $2 million, but the payout for the death benefit will be $2.6 million. So, okay, technically, yes.
So you take the cash, you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you get a better buy on the insurance than you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank. And
well,
I think that's
okay. But here's the thing:
the big thing
that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund? At age 88? It would be $25 million, dude.
Well, he's going to have that anyway.
No, instead of putting it into this rip-off thing and making 4% on your money, and when he dies, he loses his cash value. If you had put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite freaking bank.
But we're only putting in 70,000, and he's going to be.
Dude, that's how present value formula works in finance. Look, let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second. Okay, take the same amount of money when you get off the air and put it in a financial calculator at 11%, and pretend it was invested in mutual funds, and see what it is when he's 88 years old.
It'll be more.
A whole lot more.
Okay, so obviously what's going on here is Dave is doing his familiar move of just saying, oh, I can tell you you're crazy to have a whole life policy because the internal rate of return on them is, with current policy projections and such, it maxes out, in the sweet spot in the middle years of the policy at maybe a high 4 or even a low 5% rate of return, depending on the particulars, okay? Whereas Dave is saying, matter of factly, if you just go put that in a mutual fund, you can assume you're going to earn 11% a year for the next 80 years. Okay, so several problems with that. All right, so one thing is just the rate of return number that he came up with. Okay, so there, it's a bit generous to assume going forward the stock market is going to return 11%, at least in real terms. In fact, it might return a lot more than that because of a falling dollar. But in terms of the type of inflation expectations that we're thinking of now and why Dave is saying that, again, I think that's a bit optimistic. I was just looking at some numbers here. So for the S&P 500, and this includes reinvestment of dividends, if you just look back 10 years, it's 11.8%, okay? But if you look back 20 years over that period, it averages 9.3% annually. And if you look back 30 years, it's 9.9% annually. Okay, so I think Dave is doing a very particular time period where he's coming up with that 11% return. And you might have thought, oh, what's the difference, whether it's 10 or 11%? Well, no, that makes a huge difference if you're doing it over 7, 8 decades. That little difference in what Dave was assuming there makes a big difference. Okay, so there's that element. Besides that, though, that's somewhat of a quibble. Besides that, though, Dave could just as likely or just as well prove to somebody, hey, you should never own treasuries, or certainly not safe corporate bonds. You're a sucker if you buy any kind of fixed income like that, because you can obviously just make more in the stock market. What are you doing? Look at historical returns. Just basic finance theory says that the expected rate of return in the stock market is higher than in bonds, especially if they're considered to be really safe. So therefore, every money manager, any kind of institutional manager who owns fixed income is obviously an idiot. Can't they read a prospectus on a mutual fund? All right, so I think Dave doesn't say that because if he so nakedly just came out and said what his point was, that all I care about is long-run rate of return and that's it, that people would realize, no, there's something wrong there. There's a reason some investors might want to own fixed income. All right, and obviously the answer is the relative safety. Okay, so for some people, for certain parts of their portfolio at least, they don't just care about what's the long-run expected rate of return on average. They also care about volatility. They want to know, can I depend on that asset having a certain value in a particular time period? Okay, and so once you take into account that factor, then, oh, wait a minute, maybe just putting it in a mutual fund is not necessarily the best thing to do. And maybe there are considerations besides, what do I think the value of this thing will be 80 years from now? Okay, so that's just another element. Just to see the real world implication, there were people who had a lot in 401ks or IRAs, things like that, and who had retirement plans. And then when the '08 crash hit and the stock market, at least for a while there, it dropped like 40%, and then it came back. But there were people who literally had to postpone their retirement. They had to work more because what they were planning on being there They had done what the gurus told them and put all their assets into the stock market, thinking that was a safe thing to do. And all of a sudden, boom, just in a very short span, it dropped 40%. Okay. In contrast, if you have your wealth in a whole life policy, it can't go down. All right. So it has a modest built-in guaranteed rate of growth, if we're talking about the cash surrender value. And then on top of that, it pays dividends, which you can use to buy more paid up insurance, which makes the death benefit, but also the cash value march up at a higher rate. So like I said, with one illustrations I've seen recently, in the long run, yeah, it's modest. It's like high 4s, maybe low 5% rates of return. But once your policy receives dividends and then rolls over, has the built-in guaranteed growth and whatever, and marches up, once the cash value gets credited and marches up, that's a new plateau. It can't go down. All right, so there's very few assets like that. Not even bonds. You could have a bunch of treasuries and their market value can certainly go down. Just ask the people who are running SVB, right? If interest rates go up, fixed income assets go down. That doesn't happen with a life insurance policy. You might say, yeah, but isn't the life insurance company buying a bunch of bonds to back up my policy? Yes, they are. And with a whole life policy, the insurance company is the one that takes the risk. They tell you, the contract says, you keep making these premium payments and we guarantee your cash surrender value marches up at this very modest rate. And then every period, if there's dividends, then it can roll over and march up even faster. But under no circumstances does your cash value go down because of the performance of our portfolio or something like that. No, that doesn't happen. That's not the nature of the contract you have with the standard whole life policy. Okay, even interest rates going up can't make the cash value in your policy go down. So it's a very safe place to put your money. Also, there's tax considerations. Okay, so it's particularly for U.S. citizens, there's excellent tax treatment of these things where if you handle the policy properly, that internal buildup, it's technically called tax deferred, but if you use it correctly, you ultimately don't ever have to pay any tax on that internal growth. You pay the premium with after-tax dollars, but then any growth that builds up, again, if you handle it correctly, that gets passed on to the beneficiaries, income tax-free. There was never tax on the internal growth. If you need to tap into that wealth while you're still living, you take out a policy loan from the carrier where they're lending you money with that policy serving as the collateral. And that policy loan is not taxable because it's not income, it's a loan. Okay, so these things have a lot of nice features, which is why so many people, including wealthy people, including banks, and we'll get to that in a minute, use these things. And there's pros and cons, and there's certain situations where they make more or less sense. But for Dave Ramsey to be sitting here and just saying, no, this is stupid, only a fool, he doesn't know what he's talking about. Okay. Let us continue with our sampling from this call.
Then put the money in real estate, but don't put it in this crap.
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
But he's able to borrow against this.
Hey, if you've got $25 million in mutual funds, you can borrow against it.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's how he builds wealth. Said no one rich ever. Okay,
so here, again, the caller obviously has been trained in the Jedi arts, and he's explaining to Dave, well, no. Like you want him to put the money in a mutual fund, but he can't use it. And then Dave is talking about, well, no, you can borrow against it. So here, that's the problem sometimes with Dave. Like he could be a moving target. So it's not sure, what do you have in mind? So I think probably in some settings, Dave would be saying, I'm talking about putting it into a tax qualified plan and and then you can get all these great advantages where there are strict limits on when you can access the money. Specifically, if you start taking it out before you're 59 and a half, you get hit with 10% penalty, things like that. Okay, so that's what the caller is referring to as saying, no, with what I'm doing with my son, this policy, he's going to be able to use it without any penalties. He doesn't have to just leave it sitting in a prison until he's 59 and a half. Okay, so that's one element of what's going on. Let me also mention, I forgot to make the point, technically this would have gone with the previous clip where Dave is matter of factly saying, 11% rate of return in a mutual fund. What are you doing? Well, another thing that overlooks is the fact that the whole life policy is life insurance, right? And so if this guy's child, hopefully he does live to be in his 80s, and that's the issue, is him sitting around saying, I only have $2 million in my cash surrender value of this whole life policy that my dad gave me. And some people are saying maybe it would have been a lot more if it had been a mutual fund. Like, that's a good problem to have. If you have a thing that's only worth $2 million that your dad gave you, and it could have been worth something more maybe if you picked a different asset, right? Like, hopefully everybody ends up having that problem, and that's why they're mad at their parents when they're in their 80s, is that, you gave me this thing that's not only worth $2 million, it could have been something else. That would be great if that's the issues kids have with their parents. But besides that, though, this child might die early, right? We hope he doesn't, obviously, but he could. And so if he dies, so for the policy that I asked my colleague at Infineo to draw up, when the kid is 20, so again, the numbers are going to be a little bit different from what the caller's policy is going to say, because the timing of when he did this funding was off, or it's different from what I have here. But for example, the policy that I showed you folks, at the end of year 20, the death benefit is $846,000 and change. Okay. So if Dave's strategy is, if they follow Dave's strategy and the guy's putting that funding into a mutual fund and the kid happens to die at age 20, the mutual fund is not going to be worth more than $800,000, right? It's not. So again, there's different assets. So what I'm getting at is, part of the reason the internal rate of return on a whole life policy is relatively modest is that it's life insurance. It's not merely a vehicle that's taking your payments and going and investing them in assets and then passing it along to you, except for some fees taken off the top. That's not what a life insurance policy is. It's life insurance. And so from the moment you take it out, that death benefit coverage is in place. So that the caller said his policy for his son, the moment he opened it, there was a $500,000 death benefit, and then that thing is going to march up over time. Okay, whereas if you're putting in a mutual fund because, the long run rate of return on this thing is higher, well, then that's not true. Now, incidentally, you could try to split the difference and say, no, Bob, but what if we buy term and invest the difference so that we got the death benefit coverage in place early on? Okay, you can go ahead and do that, but still, there's that intermediate period where the term policy falls away. Or if you want to keep it in force, you got to renew it now with much higher premium payments. Whereas the whole life policy, it's a fixed premium payment throughout the standard design. Okay, so all of these comparisons, they're each assuming different things. So yeah, you could, if you want, have a term policy in place, but then you're not putting as much into the mutual fund. Okay, so I'm just saying right here, when Dave was trying to get this guy to see how goofy his idea was for his kid, he said, take the same amount you funded in that policy, go have it earn 11% on an online calculator, and then see how much you'd have. Okay, so in that scenario there, Dave wasn't doing buy term and invest the difference. He wasn't doing buy term at all. He was just saying, take those same cash flows, put them in a mutual fund, and assume it earns 11% for the next 80 years, and then go see how much that's going to be worth. Okay, so I'm saying if that's what you're comparing it to, it is entirely fair for me to say, okay, but if the kid dies early in that scenario, Dave, he gets way more with the whole life policy than with what you just suggested. Now, again, you could come back and say, okay, well, if that's what you're worried about, then do a buy term. Fine, but then you can't take all those cash flows and assume they earn 11%. You're not earning 11% in cash surrender value growth in the term policy. You don't have any cash surrender value growth. If the kid doesn't die during the time that the term policy is in force, your rate of return on that was negative 100%. All the premiums you paid are gone. In fact, do you know that if you have a term policy and you outlive it, the life insurance company keeps your death benefit? Do you know that? Yeah, life insurance keeps your death benefit. Make sure you go look that up. See if I'm right. It's kind of nefarious, don't you think? You're sitting here paying your premium payments on this term policy and then they keep your death benefit? Oh, imagine that. All right, let us return now to the call.
I mean, banks use this product to...
No, they do not. You've been watching too much TikTok. Banks do not use whole life. Not ever. Banks no banks sell.
I would respectfully disagree
No,
with
they
that.
don't. They do not use whole life insurance.
What bank?
Well, we could Google it and see what typically banks do with their money, but I believe
typically banks never put money. Let me tell you what banks do. They put it in bonds. They're required to. They wouldn't be allowed by federal regulations to put it in whole life. It's not a place to invest money because it's a horrible investment. The rate of return
4%.
sucks, and when you die, you lose your cash value.
Okay, so I think it would be fair to say Dave was very confident there. There wasn't a lot of gray area, a little, wiggle room. He clearly told that guy, banks not only don't in practice buy whole life insurance policies, but they would not be legally allowed to because they're such terrible places to put your money, right? We can all agree that that's what Dave Ramsey just said there. So what's funny about that is, and why I was stunned when I heard this exchange originally, at first I thought Dave was just saying or making the point that what the banks do is buy universal life and not whole life. Okay, he still would be wrong, as we'll see in a minute, but that's what I thought he was making. I just thought he was being kind of unfair to the guy when that's not the point. The caller clearly just meant banks buy life insurance as a place to store cash. They don't just do it purely for the death benefit coverage of like key employees or whatever. That part of why they use this strategy is because it makes a lot of sense financially, not just for the pure, hedge against an uncertain outcome. But the more Dave talked again, and then when he said they wouldn't even be allowed to by regulation, then it was clear. And there was no ifs, ands, or buts. He said, period, they don't do it at all. No bank does it. All right. So again, that's just wrong. So, and the reason that's funny is there is an entire asset class called BOLI, which stands for bank-owned life insurance. Right. And that's not referring to term policies that banks have on key employees. So here I'm taking these figures from BOLICOLI.com, right? So there's a whole website. This guy's business is dedicated to setting up banks. And so COLI is company-owned life or corporate-owned life insurance, setting these institutions up with appropriate life insurance policies. So his latest figures, he says, as of the end of June 2023, U.S. banks had permanent life insurance in place with cash surrender value of about $184.6 billion. Okay, so rounding $185 billion in cash value. That's just the face death rate. That's just cash value that banks owned of permanent life insurance as of the end of second quarter 2023. And Dave Ramsey is saying this is a stupid place to put your money. So apparently none of these bankers listen to Dave Ramsey's show, or they do in Chortle. Okay, now let me be clear. Most of my understanding is most of what the banks currently own is fixed UL, right? So not like variable UL and indexed and things like that, just a plain vanilla UL product, which is still, has cash surrender value and would be called permanent life insurance. They do, though, some of them own whole life policies. Okay, so again, Dave is clearly wrong, but also by extension, whole life is more conservative, is older, is more traditional than UL. And so if regulators allow the banks to own all this UL, they certainly would allow them to own whole life. And also, if you went back in time, UL is a newer product, right? There was a period in which if you own permanent life insurance, it was just whole life. That's all the only thing available. So clearly back then, banks wanted to own it, it would be whole life. All right. So here again, earlier in the call, I guess there were a few points where Dave was technically correct, and I could see how he was digging his heels in and was just being unforgiving to the caller and not trying to understand where's the guy coming from. But here, no, Dave is just flatly saying things that are demonstrably false with confidence, right? My problem is not that he happened to be wrong on stuff. Like if he said, I'd be surprised if banks owned life insurance because in my research, it seems like it's a bad investment. Really? You think they do? What? Can you send me the sort? Maybe we'll hang up and you talk to my call screener and give them because I want to look into this. If he said that, I wouldn't be making fun of him. But no, with confidence, he's telling the guy he's wrong when there's literally an asset class called bank-owned life insurance. So it's shocking to me that I don't know what's worse. If Dave knows that and just doesn't care and is just blowing the guy up, Or what's probably more likely is that Dave doesn't know that, and yet he's speaking with such authority on the topic when he doesn't even know that there's this whole thing called bully. So last point I'll make here on this episode, folks, out of curiosity, I went to the YouTube clip and I went into the comments, which generally speaking is not a good thing to do if you value your sanity, is to go into YouTube comments, but I did. And I'm scrolling through and I'm just looking for one honest man. I'm looking for one informed person in all of Greece that can tell me, is there such a thing as bully? Because they're all just laughing at this caller and, oh, I can't believe if you're going to, take a swing at the king, you better not miss that, like just high-fiving Dave for how much he blew up this caller. And maybe out of, 150 comments, there were like one or two people that it looked like maybe they knew that bank-owned life insurance was a thing. Like that was a term in the financial community. And so I said, wow, these people are so ill-informed. So I went in and typed in a comment and gave a link to the figures showing the $185 billion in cash value, bully, and was there. And then I went and checked, 20 seconds later, and my comment, I couldn't see it anymore. I said, oh, that's weird. So I typed in again, and my first comment was a bit snarky. So I made it more just straightforward, but boom, that comment got zapped too. And so I realized, oh, it's not that all of the people watching this YouTube clip have never heard of bully. It's that anybody who's trying to enlighten Dave's followers is being censored. All right, so that's unfortunate, but it kind of explains why, the pattern I observed. Like, how could it be that all these people, you're telling me nobody knows about bully? No, some people did, and apparently they were not allowed to express themselves. Okay, so why don't we wrap up there? That's a good logical stopping point for this episode. The conclusion, of course, is that there is a lot of misinformation out there about the use of whole life insurance policies, not just for death benefit protection, but also, as we say here at Infineo, as cash management vehicles. So if you want to learn more, check us out, infineo.io. In any event, folks, thanks for your time, and I'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.